This conference will now be recorded.
One of the things, advantages when we do use this method is that, the session is recorded and then it'll go to my YouTube channel. So you can always go back and review it. So let me see if I can share my camera, share my screen. And, last time we looked at depreciation and you had these problems to work we'd already looked at depreciation, of course, before, and it was simply a matter of we have an asset, it goes down in value. You got to reduce that value on the balance sheet and recognize the expense. So we bought the asset, we record the depreciation each year, full year life. We make this entry each year, not 1 year, but each year. And we had the example which you were supposed to finish. We did the first 3 or 4 years. Uh, and if you finish the example, if you're using straight line depreciation, where we divide the life into 100% to get that rate, the depreciation expense is $4,000 every year. But we own depreciate it till the salvage. We can depreciate the 40, and it was $4,000 a year. When we went to double declining balance, we wrote off more initially, 10, 8, 6, 4. But when we got to year 8, we could no longer, we could take 690, which would get us to 40,000, and that would be it. So here we just write off more of the expense earlier. Are there any questions on depreciation? If not, let's move to stockholders' equity. And what I told you that shares of stock have a value. Okay. There's a dollar amount on those, and I told you to look at a situation where that amount was $100 was the par value for the stock. And if you issued 1,000 shares with a par value of 100, but the price is 150, you would get 150,000 in cash. You credit common stock for 100,000, which is 1,000 shares times 100. And then what you paid in excess of that par value would be paid in capital in excess of value. It costs money to, you can't just do stock certificates there. They have to be recorded with the state and everything. The certificate sent there at a legal price. And so if the stock goes up in value, the company does not want to change that par value because it would cost. And so when they get more, they just put it in paid in capital in excess of par value. Then we talked about the fact that if a company buys the stock, because this is the legal capital, if a company begins to take money out, that needs to be highlighted. And so we don't debit common stock, we debit treasury stock. We don't debit common stock, we debit treasury stock. And shareholders' equity, when you work the next problem, needs to look like this. The common stock, the par value of that stock, the paid in capital in excess of value, total paid in capital, retained earnings, subtotal less the treasury stock, total equity. So before we were just saying, okay, they got 150,000. Now, what actually happens is that you got to separate it between how much is in uh, regular stock and how much is in, the amount excess par. So basically the same journal entry. And then with the treasury stock, it has a debit balance and it shows like this. And so still, these are the items on there. No dividends, of course, or on stockholders' equity. Are there any questions by anyone? Are there any questions? Okay, if not, let's move on to merchandising companies. And so this is the last major item that we work with. We will probably have a homework that will be due on this Thursday that we get back. We'll have a quiz on this the last Tuesday of class. So there's an inventory homework that's going to be due, different for the A and B students. There will be a quiz probably on that final Tuesday. And if the A students finish that quiz completely and correctly, then they will be exempt from the final. Then on the last day of class on Thursday, I will review, and you'll have it ahead of time, a problem very similar to the final. And when the final is given, uh, I simply change the numbers. And so for the students who've taken the final, we will review exactly what that final will look like. Okay, so let's begin then to look at uh, man, managerial merchandising accounting. And in merchandising accounting, there are three journal entries. Journal entry one, you buy the inventory. We didn't have to worry about this, the service business, but we buy the inventory. And then we have two subsequent journal entries. One where we sell it for cash or receivables and we credit sales. And then we have to record the cost of goods sold. That is, we buy the inventory. We don't want it to stay there. We want it to move from inventory to cost of goods sold, so we have the sale. So that's what all the companies are planning for on Friday and between and afterwards. Uh, they're looking at and they're hoping to see uh, that the inventory has been, they bought it already, and now they want you to come in so you could buy that inventory and they can make their sale. But we said that we're going to change our approach, correct? Didn't we say that? And in changing our approach we're going to be the ones that are going to be selling the inventory. That is, we're going, so instead of what we traditionally do, what we're going to buy, we're going to look at what we're going to sell. And we said that now our income statement is sales, less the returns and allowances, debt, less the cost of goods sold. Did we make a profit? Did we sell our inventory for a price greater than what it costs? Then we subtract the operating expenses to get our net income. When we do closing entries, we got to close out the sales and the returns and allowances in closing entry one. Closing entry two, we will be closing out cost of goods sold and the operating expenses together. So cost of goods sold is closed out by crediting it just like we credit these other expenses and we debit the income summary. Closing entry 3 is always the net income, and of course, closing entry 4 is depreciation. Any questions at this point? Okay. Let's go back and review our example. We just go into this last one where we bought the inventory for 20 and we sold it at 50. And we said that in this last one, we purchased 10. So if we purchased 10 items, we would debit inventory for 200 and we credit accounts payable for 200. Then if we sold 8, we debit cash for 400 and we credit sales for 400. Since we only sold 8, we're going to debit cost of goods sold for 320. We're going to credit inventory for 320. When we prepare the income statement, we have sales at 400, cost of goods sold for 320, and a gross profit of what? Was not 320, it's 160. And so our gross profit then, and I'm always looking for the gross profit, would be 340. Move that down. And we have left in inventory 2 at 20. Are there any questions by anyone on this simple example? Are there any questions by anyone on this example?
Yes, I have a question.
Okay.
I'm still confused on how we got 320 since you switched the other one to 160. For the cost of goods, the
This should
sale.
be 160 also. The cost of goods sold will be 8 at 20. Okay, so I just put in that 3 something uh, erroneously. So we clear, thank you for that. It's great. Are we clear? Everybody's clear on this. Okay, time to run our shoe store now. And when we run our shoe store, the shoes cost different prices. Okay. When we run the shoe store, they don't all cost the same thing. So we're going to assume our selling price is 50. And we're going to buy, some of the shoes cost $20, some cost $25, and some cost 30. And we're assuming that the first ones cost 20, then the price went up to 25, then the price went up to 30. So let's look at this first example. We purchased 10 pairs of shoes and we purchased 5 at 20 and 5 at 25. And so when that happens, we're going to have more, and I'll just get this up. It's in here now. Every time we buy the shoes, we got to make this entry. So every time we buy the shoes, we make this entry. So when we buy 5 at 20, we have 100. We debit inventory for 100 and we credit accounts payable for 100. Then we buy the second set at 125. We debit inventory for 125 and we credit accounts payable for 125. So we record both purchases. Now, in this first case, we're assuming that we sold 10. So when we sell the 10 and we sell them at 50, selling price 500, sales 500. Cost of goods sold now is going to be 100 and 125 or 225. Our income statement is going to show sales of 500, cost of goods sold 225. And so our gross profit is going to be 275. And we have nothing in inventory at this point. So there's nothing left in inventory. Are there any questions on this example?
Yes, could you please take it again? Because I'm kind of lost.
Okay. When you buy inventory, it does not cost the same thing all the time. It does not cost the same thing all the time. And so we bought 5 pairs of shoes at 20. We bought another 5 at 25. Okay. Shoes don't cost the same thing all the time. We made 2 purchases, 5 pairs at 20 for 100, 5 pairs for 20 at 125. Any questions?
No.
Then we sold all 10 pairs. You know, when you go into a shoe store, no matter what was paid for the shoes, they got one selling price on them. Okay. So when you sell the 10 pairs, you get $500, but your cost now is 100 and 125 or 225. Okay. So you have to add what those costs are. And our gross profit is 275 and we have nothing in inventory. Are we clear? Now, let's look at what happens when we don't sell all the shoes. Suppose we only, same situation, we bought 5 at 20, 5 at 25. So these numbers stay the same as we run our shoe store. But we only sold 8 pairs of shoes. So if we sell 8 pairs at 50, how much we gonna get? $400, correct? But what's our cost gonna be? We're going to make the assumption that we sold the first ones first. So 5 at 20 means we sold the oldest pair first, 100. But because we sold 8, we're going to sell 3 of these at 25. So this is going to be equal to 75. This is 5 at 20 equals 100. And so now our cost of goods sold is 170. So we debit cost of goods sold for 175, credit inventory for 175. Our income statement in this situation has 400. Cost of goods sold is 175. And so now our profit is going to be what? 525, 225, I believe. Any questions?
So how,
And we have in inventory 2 at 25 equals 50. Now, we have to, and what we utilize is an inventory method called first in, first out, a FIFO. When we use this method, we assume we sell the oldest items first. And once we started using this method, it always has to be that case. We can't say we sold, the 25 ones first the next time around. We always got to sell the old ones first. Now let's look at a situation where we sell 3. Where we sell 3. So once again, these transactions stay the same. Let's see. But if we sell 3, we're going to get what? $150. But what's 3 we going to sell? Because we're using first in, first out. We can't jump down here and use a higher cost. We got to sell the 3 at 20. So everyone see that? And so our gross profit now is going to be selling price, 60 sales, 60, and cost, excuse me, wait a minute, cost goods sold and inventory. In this case, we simply have 3 at 20. So 60, 60. And of course, this should have been 150. Kind of jumping down here. So now when we do our income statement, we have the 150 for the sales, the cost of goods sold is 60. So the gross profit is 90. And now we have that row out of there. And in inventory now we're going to have, since we only sold 3 of these, we got 2 left at 20. So that's going to be equal to 40. And we got all of the 5 at 25. That's going to be equal to 125. Any questions? Are there any questions?
No,
How
sir,
did
not at the
you get
moment.
40 and the 125?
Say that again.
How did you get 40 and 125? Like the
Go back
in
up here. We bought 5 at 20 and 5 at 25. We sold
oh
3. So we had 2 at 20 left and 5 at 25. We had 2 at 20, 5 at 25. Any questions? Okay, time for you all to work then. I want you all to work on the situation where 3 inventories were bought, 5 at 20, 5 at 25, and 5 at 30. And you sold 7, and you're using the first in, first out convention, so you're selling the oldest ones first. So take about 10 minutes and see if you can get this worked out. You should have it. So take 5 or 10 minutes and see if you can sell these inventory. So, how much money did we make when we sold 7 pairs of shoes? That's always the question. How much money did we make? Anybody come up with a gross profit yet? Well, let's start off here mighty quiet, which I'm not used to, of course. We're going to buy 5 at 20, so that's 100. Then we're going to buy 5 at 25, so that's 125. Then we're going to buy what? 5 at 30, that's 150. So these are our purchases of inventory. We got 3. So 7, so all the shoes, sell them for the same thing. We don't change the prices. So if we sold 7 at 50, that would probably be how much money?
350.
350. Okay. What's the cost of these shoes going to be? We're going to sell all the old ones first. So we sold 5 at 20. So that's going to equal 100. Then, since it's 7, we're going to get into this next layer, 2 at 25. That's going to be equal to 50. So our cost of goods sold is now 150. So when we do the income statement, we have sales of what? 350. We have a cost of goods sold of 150. Our gross profit is $200. And left in inventory would be 3 at 25. Be $75. And then we'd have the 5 at 30, which would be 150. Any questions? Are there any questions?
Is this gonna be on the final?
Of course. That's why we're going over it.
Okay. Okay.
And Ms.
Wait,
Washington,
this is gonna be on what?
the final, the quiz in a week or so, everywhere. Well, what y'all think's going to be on the final? All right. Are there any questions? Are we ready for a quiz today?
No. And can you scroll
Today,
down?
Say what?
today.
All right. Well, I'm just saying if you don't have any questions.
Can you scroll down?
Okay. Now, the shoe store is going to be doing this all
Okay. Thank you.
at now. Are there any
Yeah, I
questions?
was.
Yeah. What's the question?
Is there any journal entries that's associated with this?
Here they are. Purchase the inventory. These are the journal entries. Sale. These are the journal entries. I just got them going across. And cost goods sold inventory. If you remember, when we are dealing with inventories, there's three separate journal entries. Number one, when we buy the inventory, and we make this journal entry as many times as we buy inventory. So in the first example, it was 2 times. In the second example, it was 3 times. And then whenever we have sales, and we just have one sale now, we're debiting cash and crediting sales. But we also debiting cost of goods sold and crediting inventory. So in the example that we have set up, these are journal entries, journal entries, journal entries, okay? These are all journal entries. I just have them set up like this for this example. Inventory accounts payable, inventory accounts payable, inventory accounts payable. That's a journal entry. When we sell it, debit account receivable or cash and credit sales. Then that second entry, debit cost of goods sold and credit inventory. These are journal entries. We make those journal entries, and then we prepare our income statement. So we're just concentrating on the inventory. Eventually, we'll get to a problem, where we will tie it all in together in terms of a regular problem. Any questions? Any further questions? All right, work this one here where we sell 12. So go through and take your time, follow the steps, and work this. So you have about 10 minutes to get this one worked. Are there any questions? So just go step by step. Buy the inventory, sell it, get your cost of goods sold, prepare the income statement format at the top, and then tell me how much is left. But once again, you got to look at the facts and work it out. And so you should be realizing that what? The first three journal entries are the same. So you should not be taking a lot of time on getting that done. The first three are the same. So go through and get that done, then move on down to the others. Are there any questions? All right, you got 10 minutes. Okay, how much money did we make this time? I don't have any A students. Okay, let me see. Somebody says sales at 600. Inventory 285 and gross profit 315. Anybody else get this? Anybody else get 600, 285, and 315? And since we had 12, we sold 12. We'd had 3 at 30 left in inventory. 3 at 30 equals 90. So let's look at how our shoe store got that. So we said these entries were all the same. And we sold 12 pairs of shoes. So 12 at 50 seemed like that would be about $600. For debit account receivable or cash, and we credit sales. Let's see how we come up with the cost. We sold 12. So we sold all 5 at 20. Then we also sold all the 5 at 25. So that would be 125. And then we sold what? 2 at 30. That would be equal to 60. So when we add these together, uh, 100, 125, and 60, we get 285. So we get ready to work off our income statement. Sales 600, 285, cost of goods sold, gross profit 315. We have 3 left in inventory at 90. So how we coming on running our shoe store? How we coming on running our shoe store? And so what we did in this example, was to buy the shoes at different prices. So we had to have a journal entry every time we bought it at a different price. And then we would make the assumptions that the first ones, the top ones, were sold first. So here we sold them all, but when we didn't sell them all, we sell the top ones first, then the next layer, then the next layer. So this is what shoe stores do all over the world. There might have been some answers in your We have three inventory evaluation methods. First in, first out, that's what we just looked at. Then we have LIFO, last in, first out, where we sell the last ones first. And then we have weighted average, where we do an average. So those are the three methods. And then if you have high price items, jewelry, automobiles, you're going to identify what's sold. But with shoes, we won't do that. So hopefully this example sort of shows you what happened. In, first out, the shoes are bought and pushed forward. And then when somebody buys something, they get the first one, the old ones first. The new ones are back here. And so the old ones are sold first. If it's first in, first out, it would be like a warehouse where everything was pushed in the back and then they got them from up here up front. So that's last in, first out. So first in, first out, C students, you got to be able to do that, what we did today. For the B students, you got to be able to do first in, first out, or last in, first out. You got to be able to sell it if the new inventory, if the old inventory is sold first, you got to be able to do it if the new inventory is sold first. And this is another example of that, but I think the other example, it's like if you packed everything down here, but you sold up top. And then for the A students, you got to be able to do weighted average. And in weighted average, we come up with an average of what's going to be sold, get our cost of goods sold. So we don't sell the top one, we don't sell the bottom ones. We get an average of what's in the inventory and we sell that. So those are our three inventory methods. Weighted average, where we average what's in the inventory. LIFO, where we sell the ones that came in first, we sell those first. And then we have FIFO, where we sell the oldest ones first. So FIFO, we sell these old ones first. LIFO, we sell the new ones first. So those are the three methods, and based on that assumption of consistency, based on that assumption, you got to use FIFO, LIFO, weighted average. You can't switch it. So let's go back to FIFO and look at this example again. Different example this time. We purchased 100 pairs of shoes at $15 each. We purchased 200 pairs of shoes at $20 each, and we sold 150 pairs of shoes. So we're just looking at this one example now, and we're using FIFO. To keep track of our inventory, we got what's called an inventory flow chart. We have an inventory flow chart because if we have a lot of transactions, it would be difficult to keep track of them. And so what happens is, you see a journal entry 1 and journal entry 3, those are the only ones that come on the inventory flow chart. That second journal entry, sales, does not come on this flow chart. And I'm going to say it again. We have journal entry 1, the purchase, and journal entry 3, the cost of goods sold. Those are the only journal entries that come on the flow chart. And for the third time, on the purchase journal entry and the cost of goods sold journal entry come in the sales chart. Sales prices are never on the inventory flow chart. So let's look at what we do. We purchase 100 pairs of shoes at 15. Then we purchase 200 pairs of shoes at 20. So when we buy the 100 at 15, that's $1,500, I believe. So we debit inventory, we credit accounts payable for 1,000,500. Then we buy another 200 at $20 each. And that's going to be, if we buy 200 at $20 each, that's probably going to be $4,000, I'm assuming. We bought 100 at 15, 200 at 20. This purchase journal entry we're going to put on our flow chart, you know, so because when we have a lot of transactions, we keep going, we need this flow chart to keep track of it. So we're going to put 100 on here. The unit cost is $1,500. Then we're going to move this over to the balance column in terms of what we got available for sale. Then when we buy the 200 pairs at $20 each, 200 at 20, you got 4,000. And we're going to move that over to what's available to sell. So we have this is what we have available for sale. Our third transaction, we sold 150 pairs of shoes for $40 each. We sold 150 for $40 each. So if we sell 150 for $40 each, that's going to be 6,000. Now we need to get this cost of goods sold number, and we come to this chart to get the cost of goods sold number. We come to this chart to get our cost of goods sold number. Okay, we sold 150 pairs of shoes. So we sold these first. Now these are all gone. But since we sold 150, we got to come into this layer and get 50 more. So we're going to get 50. They're in there at 20. And so 50 times 20 is going to be 1,000. So we'll add these two numbers together, and our cost of goods sold is going to be 2,500. So notice what we did when we purchased the shoes. We put them here, and we put them in the ending balance. But when we sold the shoes, we're pulling them out to put them in the cost of goods sold, this journal entry. We add them up, 1,500 and 1,000, we get 2,500. And so the 2,500 is what comes here. Now we gotta say, okay, how much we got left? What we have left is we don't have 200 of these anymore. we have left what? 150 of the bottom layer only. They're in there at 20. So this would be $3,000. So every shoe store has this for each size. They have a card. You know, it's computerized and everything, but this is what this card is doing. So now we're able to go ahead and come up with our cost of goods sold. The sales were 6,000, cost of goods sold 2,500, and our gross profit was 3,500. Okay. Now what actually happens? What actually happens now? Let's have a couple more transactions, and you see why we're using this approach. So let's move to transaction 4, and in transaction 4, we purchase 300 pairs of shoes. And let's assume that these 300 cost $30 each. So now we're purchasing 300 at $30 each. That's our next transaction. So let's make this journal entry. If we purchase 300 at $30 each, that's $9,000. And so we got to make another one of these journal entries here.
Where did you get 6,000 from?
Get what?
6,000.
Here, that was when we sold 150 at $40 each. We sold 150 at $40 each. Okay.
Thank you.
So now, we run the shoe stores. We're continually buying and selling shoes. So we bought 300 at $30 each. So that's going to be an entry of what? 9,000. So we're going to debit inventory for 9,000 and credit accounts payable for 9,000. Then we're going to put that transaction on our inventory chart. So we bought 300 at $30 each. So we have 9,000. Now we purchase something, we move it over here. Now we need a sale, and let's assume that we sell this next transaction. We sell 200 pairs of shoes, 200 uh, at 40. So this is what happened. We're buying and selling. So we will continue to do that. So that's why we have to have this flow chart. You know, in the first situation, we just look at each sale independent, but in actual practice, you know, it'll be a continuation. So when we sell 200 at 40, when we sell 200 at 40, when we sell the 200 at 40, we got to have a repeat of these transactions. We have the sale transaction and the cost of goods sold. So if we sell 200 at 40, that's going to be what, $8,000. So we're going to debit cash for 8,000, our receivables, credit sales for 8,000. So that's 40 at 200. But now I got to come to this inventory flow chart to get 200 pairs of shoes. So we're going to bring these in. Now these are all gone. But we sold 200, so we got to get what? 50 more. So that's going to come out of this group at the 30. So when we do that, then 50 times 30 is what? $1,500. And so now our cost of goods sold is going to be 3,000 plus 1,500, 4,500. And we no longer have 300 pairs of shoes, but we have 250 left at 30. That should be 7,500. So now this is the cost of goods sold for that transaction, 4,500. So here we're going to have cost of goods sold debited 4,500 and inventory credited 4,500. Now when we get ready for this income statement, we got to combine both sales. There's a sale for 6,000 and there's a sale for 8,000. So we got to add those together and sales now become 14,000. And we got to add the cost of goods sold together. We got 4,500 here and we got 2,500 here. So that's 7,000. Now our gross profit is 7,000. So our it's going to keep changing. So every day it builds up and it adds up. So what you need to do go back and review this FIFO example and make sure you can do it. Okay. So we work through the whole FIFO example, make sure you can do it. Then, actually, in terms of how things are going to look, it's going to be like we're going to have continuing transaction, purchase, purchase, sale, purchase, sale. So you're going to need to begin to work with that, become familiar with this inventory flow chart, and you can see why if you got that same product and you're selling it, you're going to have to just keep track of it going with this flow chart. You're going to make these journal entries. Next time we'll introduce the T accounts to put those things together. But those are inventories, and so this is the last thing you got to learn this semester, inventories. For the C students, you just got to learn FIFO, first in, first out. For the B students, you've got to learn first in, first out, and LIFO. And in the LIFO, we just simply selling the newest ones first. And then for A students, you got to add to it the weighted average. So probably that Tuesday when we, not when we get back, but that Tuesday of the last week, we'll have that quiz. And it'll have all three methods on there. But C students just have to do FIFO, B students have to do FIFO and LIFO, and A students have to do all three and pass it if they want to exemplify. Any questions? Well, I hope you all have a pleasant holiday, and I will try to put a practice problem in for you to begin to work on this homework problem. Probably won't be due until next Thursday, so you can begin to work with this. It's not the toughest thing, a little different. Got to pull some things together. But this is your first time seeing it. First day of class, you couldn't make a journal entry. Now you can make journal entries. By the last day of class, you're going to be able to run a shoe store and sell inventory. Any final questions or any comments?